made it. We're in Dubai.
We made it.
It's been a rough 24 hours for everyone flying in, but so far everyone's safe and well. And events are moving around a bit, but there's a lot of people here for blockchain, for crypto, for digital asset funds. So we're in for a good few days.
Yep. Grateful to be here. Thanks for having us.
We're getting more and more people coming to the region. Dubai, Abu Dhabi.
Yep.
What's the Talos take on this as a new market?
Yeah, we're very excited about the region in general. We already have a few clients, and I've just come back from Abu Dhabi. We have a whole bunch of hedge funds there that we're talking to. At the same time in Dubai, they've had success with the VARA license and attracting a lot of talent and firms. And the ADGM has also got a great reputation. And so we are very excited for the region in general.
So it feels real. It feels it's not just hype for the machine. There are people actually moving here.
Feels very real. We have real clients, and hopefully some more soon.
And how does it compare to the other markets you're in? Because you're in the US, you're in the UK, you're in Singapore yourself.
Yep.
What's the shape of Talos globally?
Yep. So look, we're a global firm. We have clients all over the world now. At this point, we're the largest provider of trading technology to the buy side and the sell side. The makeup of clients changes in regions, and the strategies that they deploy as well is different. In the US, you just have the massive scale of the buy side there, and the sell side, to be frank. We have a lot of the classic traditional hedge funds and asset managers. In Asia, you have a lot of prop shops and crypto funds and pioneering derivatives trading firms, and you also have the sell side there. In Europe, you have a lot of large asset managers. And then in the Middle East, we're now seeing emerging hedge funds, crypto funds, and brokers that are entering the space and trying to work with this asset class. And so we believe that we have technology that can solve some of their problems.
So there's a kind of two groups there really. If we really boil it down, is established, maybe TradFi funds who are looking at crypto markets, digital asset markets, and the future of tokenization, which is probably a whole separate topic, which we won't go into right now, but hopefully in the future. And then you've got the fresh out of the box new crypto funds who are building from the ground up right now, which is really exciting. How do you guys approach those two very different markets?
Sure. Yeah, we serve both of them, and they both have different levels of sophistication and strategies that they deploy. Traditional hedge funds are very sophisticated, and when they enter, they have to go through a learning experience of what the unique challenges are of working with this asset class, and we can get into those. Crypto funds are typically leaner and much more savvy when it comes to digital assets and the supporting infrastructure. Both of them are sort of deploying either directional investing, long-term value investing, arbitrage type strategies, maybe your basis trading, or they are doing yield plays, where they are doing a combination of staking and trading at the same time.
Yeah, we were working with Figment this morning in partnership with you guys for our crypto brunch, and you guys are quite closely partnered with Figment in the staking side.
That's right. Yeah. So we have the way that we work is we try to integrate with all the best providers out there, whether they are custodians, prime brokers, exchanges, OTC desks, and also staking providers. And Figment is a partner of us on the staking side. So if you happen to be a hedge fund that is custodying with X custodian, trading at these venues, using Talos for the execution piece, and staking with Figment, it all works very well together seamlessly.
So you mentioned the challenges that funds might face here when setting up. I got a two-part question for you there. One is the operational side and what makes it operationally easy or efficient to get a fund working. But then from my perspective as an ex-marketer, as a sales guy, having the correct name on the DDQ and being seen as a fund with a stable setup is also it's also very important, especially when we're getting to this hopeful institutional wave of capital. For you guys there, how are you addressing those two points?
Yes, you're absolutely right that having the perfect setup or the ideal setup, and that's why we talk about infrastructural alpha, is very important. It means that regulators get a sense of comfort, investors and their stakeholders get a sense of comfort, and then operationally as a firm, you're more efficient in terms of your costs and your trading as well. And so getting back towards the challenges, what we see is that typically when a firm wants to trade digital assets, deploying whatever the strategies are that we talked about earlier, they encounter a few hurdles that they need to figure out, right? So the first thing is, how do they safekeep and move these assets? And so you need to figure out what custodian you're going to use, whether it's self-custody via technology or working with a qualified third-party custodian. Then you're going to have to decide who are you going to trade with, where's your liquidity going to come from? And you can trade with public exchanges or you can trade with OTC desks, and both of them have their strengths and weaknesses. Public exchanges, which require you to pre-fund, which is a unique and kind of almost clumsy thing about this industry, or you can work with OTC desks, who are more institutional and professional, but at the same time, they can give you credit lines, but they may not offer all the different coin pairs that you're looking to trade. And so that's to do with your liquidity. And then the tools that you use to trade and settle, if you talked to me 5 years ago and you were a hedge fund and you wanted to work with digital assets, you would only really have retail-ish tools to work with. When you're a professional hedge fund that's going to be moving tens of millions when you trade, and you don't want to have slippage and you want to ensure best execution, typically you want to face the market and be able to aggregate liquidity across all the different pricing and liquidity that's available out there. And so in earlier days, a lot of the tools like algorithmic execution and transaction cost analysis and aggregated liquidity, that didn't exist. And now firms like ours are bringing these solutions to the table.
Do you think we still have, in a relatively nascent market, in I guess kind of global terms, do you think we still have a long way to go for that sophistication to evolve, or are you guys really kind of pushing the envelope as is?
So what I've seen is with every market iteration, there are more and more professional firms that are bringing institutional grade solutions to the market. And that gives me comfort because I see that the ecosystem becomes more mature and stable and institutional friendly. At Talos, what we're focused on is the end-to-end life cycle of trading, right? So that's from pre-trade, how do I connect to all these different liquidity venues? Because unlike the traditional world, there are no standards. And so some are using APIs, some are using fixed connections. And how do we make connectivity easy? And then after that, how do you deploy tools such as a TWAP or some kind of other algorithmic execution strategy to ensure that you don't move the market when you drop your large price or when you drop your large order? And then finally, afterwards, you want to prove to your customers that you got best execution, or you want to talk to your liquidity venues to improve the pricing they give you. You want to have that transaction cost analysis. And then maybe you want to look at your risk across your different portfolios. How do you attribute that risk, and how do you then trade off that? All these kinds of tools are really well known in the traditional world. We are bringing that suite of services to the digital asset trading world.
So within that, we're in a position where instruments are, we've got the kind of the entry level stuff, but they're evolving rapidly, and we're going to start to see tokenization come into also on real assets as well. From a layman's perspective, and obviously from outside the crypto world directly, at least on a day-to-day basis, what's your opinion on me being the layman, not you being the layman? What's your opinion on where instruments are now and what you can trade via Talos and via other kind of the other providers, and where they'll be in the next few years?
Yep. Sure. So we're a software provider. We're a B2B software as a service. And so we can integrate with all these various liquidity venues, and whatever they offer, you can trade on Talos. And so you can trade spot, futures, perps, derivatives, like options. And so, in terms of the instruments available, right? So we've seen crypto be the first emerging asset class under digital assets that has gained popularity. And most of our clients are trading crypto at scale. But the scale is very small compared to a mature market like FX. And so it's going to take time for even crypto to mature. But beyond crypto, and within crypto, you have spot, you have futures, you have perps, and you have derivatives, which are all sort of growing. But beyond crypto, you have now the emergence of stable coins. And as you mentioned, people are quite excited about tokenized assets as well, which people think that are going to bring liquidity to previously illiquid financial instruments. And there's going to be a lot of innovation and product innovation for investors. And so we are excited about all of that. Our infrastructure will be useful to connect to all of these new markets. And yeah, that's kind of where I see the market today.
So if you're a fund trading desk and you want to set up, what routes, what are the arguments for build versus buy? What would you advise people?
Yeah, sure. I mean, so what we usually say, so often when we are working with a mature hedge fund or even a sophisticated crypto fund, they have their own CTO, they have their own engineers, and there is this tendency to also build yourself. My personal advice would be, if your alpha is coming from your low latency connectivity, and maybe you're doing very sophisticated arbitrage, then perhaps building yourself might make sense, since you own the IP and things like latency are very important. For the general use cases that we see though, whether it's medium frequency trading or even like high frequency trading, but not necessarily lowest latency, we tend to feel like we are trying to commoditize, or our software is trying to commoditize some of the things that engineers should not waste their time doing, whether it's around market connectivity, whether it's around standardizing data, pulling in your trades into a single source, or algorithmic execution and data analytics. These are things that we provide as a toolkit, as a service, so that you don't have to spend your engineering on things like this, and rather your engineers can focus on your alpha, and your alpha will come from your signals, your customer experiences, your customer support, your data. This is what we tend to advise firms who are moving into digital assets, and sometimes they decide to build for themselves and come to us later when they realize that they have to maintain clumsy APIs with all the different exchanges and OTC desks that are constantly updating them, whereas we have teams dedicated to sort of commoditizing this tech and making it almost available as a service, and also on an ongoing basis. As we innovate our product full time, we're rolling out code and features to our customers on an ongoing basis, and there are massive benefits to that, along with a 24/7 support model, right? Because crypto is trading 24/7. 3 in the morning on Sunday, something goes wrong, and crypto markets, when they get volatile, things go down. You want to be able to talk to a level 3 engineer and help you, and that's another service that we offer.
Do you think there's any preference from the LP side there on what routes people would take?
To be honest, I think that the LPs that we work with, we see them as excellent partners, and we represent a channel of institutional flow to them. They know that when clients are trading through Talos, that the connectivity and the standards and the stability of the connections and the order flow is going to be very high, versus some firms who have just kind of winged it themselves and are trying to sort of quant trade or systematically trade with sloppy code. And so I feel like LPs value us and the role we play in the ecosystem, and we are a very neutral party. We are connected to over 60 venues now, from the exchanges to the OTCs, and custodians and prime brokers. And so we feel we're very grateful for the role that we play in being a connectivity network for firms that want to orchestrate all their various relationships. What I mean by that is that if you're a hedge fund and you decide that, okay, I want to work with this custodian, I want to work with these exchanges, these OTC desks, and this prime broker, when you establish those relationships and then put Talos in front, it really helps you orchestrate all those relationships, because from one screen or one API, you're able to complete your end-to-end trading operations.
So within that and within the infrastructure we're talking about, and I realize the irony of talking about infrastructure when we're in Dubai and it's completely flooded, but it's once in a lifetime type thing. Do you think that the providers such as yourselves and that marketplace is going to evolve significantly over coming years? In terms of, are we going to see consolidation? Are we going to see some people dropping by the wayside? There's been obviously a lot of money, VC money, gone into the infrastructure side of things.
Yep.
So there's quite a bit of, let's call it dry powder, for want of a better word, in this situation, sitting in the service providers' coffers.
Sure.
And a lot of sunk costs from the VCs, which they'll probably want to follow. How do you see that landscape evolving in terms of a GP trying to get a handle on the landscape?
Yeah, great question. I mean, what I would say is that for certain verticals, you already have quite mature and established companies that are emerging as front runners, right? So if you look at the compliance and on-chain analytics firms, there are some really great names out there with mature product offerings. If you look at custody, there are already great custody infrastructure providers. And so yes, what I would say is that some of these verticals have been solved for, but there are so many ancillary services and support needed, infrastructure companies needed, for the entire life cycle and value chain of digital assets, whether it's tax to risk management, etc. And so there is plenty of blue oceans or opportunities for firms to come in and solve problems for. Having said that, in our space, we started off as only an execution provider for the buy side. Now we support the sell side as well with our white label technology, and we have built not only vertically, but we've also built horizontally because of customer demand. So customers have said, hey, we really like your trading system. Can you help us with risk management, treasury management, settlement, etc.? And so now we are branching a little more horizontally in our product suite. How do we do that, right? So we hire teams. This could be through M&A. And so we're building a lot based on what our customers are asking us for, and we're grateful for their trust in us. So yes, I do think that the industry will consolidate. There has been some already where over the last bear market, some of the firms that didn't have sustainable business models kind of got flushed away. But in general, I think it's going to be good for the investors and the firms because they're going to have a choice of very good providers with good sustainable businesses to work with. And it's going to be less confusing.
That bit there, when we get more clarity about the structure and where to go, I'm very excited about that. I'm very excited about tokenization.
Yep.
And tokenization across real assets,
yep.
Tokenizing hedge funds, tokenizing VC,
yep.
adding liquidity where it wouldn't always be, tokenizing startups.
Yep.
Very, very exciting as well. What are you excited about in the next few years?
Look, first of all, at Talos, we're excited about our growth. We're talking to such amazing companies on the buy side, the sell side, hedge funds, crypto funds, fintech apps, stock brokers, OTC desks. So we're just really excited about the growth across geographies and our products. Having said that, you're right. On the macro story, you've got a bunch of ETFs being approved, whether in the US, but also now in Hong Kong. So you've got institutional involvement at scale happening. You've got retail involvement. It's an exciting time. At the same time, you have innovation in DeFi. You have all the new staking options that are happening. And then you've got this tokenization play. Right now, none of our customers are trading any tokenized assets today. But 2 years from now, we believe it's going to be a much bigger pie than what's in crypto today. Yeah. And so the technology itself is going to revolutionize financial services, and we're just excited to play a role in solving one of the problems for that kind of macro story.
Fantastic. Well, thank you so much for your time today. Thank you for the support of Crypto Brunch, and we'll see you in London, New York, Miami, Switzerland, Singapore as we move forward.
Thank you, Gus. Thank you for your time.